So when I say the word Qualcomm, what's the first thing that pops into your head? I bet for most of you, it's smartphones, right? The little chip that powers your phone. But what if I told you that's not even the real story? What if the market has been getting this company completely wrong for years? Today, we're going to tear down that common myth and get to the reality of what makes Qualcomm tick. It's a fascinating one.
And here it is, laid out plain and simple. On one side, you have the myth, the story everyone tells. Qualcomm is just a smartphone chip stock. Its fate is tied to whether people are buying new phones this year. But the reality? The reality is so much more interesting. It's a hybrid royalty franchise. That might sound a bit jargony, but stick with me. It's a completely different and way more powerful business model. This is the disconnect we're going to dig into.
All right, so what is Qualcomm's real identity then? The best way to think about it is this. It's a super powerful wireless IP royalty engine that just happens to have a massive chip-making business attached to it. They're really two different beasts under one roof. So let's pull them apart, and we're going to start with a part that almost everyone misses.
Okay, layer one, the royalty engine. And folks, this isn't just some side hustle for them. This is the absolute foundation of the company. It's the crown jewel. The official name is QTL, which stands for Qualcomm Technology Licensing. And believe me, it is the key to everything.
All right, get ready for this number because this is where your jaw might drop a little. 77%. That was the EBT, earnings before tax, margin for their licensing business in Q1 of fiscal 26. Let that sink in. 77%. That is it's an insane level of profitability. You just don't see numbers like that. Most companies would kill for a fraction of that kind of margin. I love this quote because it just nails it. Think about it this way. Qualcomm doesn't just sell the engine for the car, they own the patent on the highway itself. Because so much of their technology is essential for how 3G, 4G, and 5G work, pretty much everyone in the mobile industry has to pay them a small fee, like a toll. They're literally collecting rent on the digital superhighway. It's brilliant. Okay, let's look at the actual numbers for fiscal 2025 because this really puts it into perspective. You've got the chip business, QCT, on one side. A huge number, right? $38.4 billion in revenue and a 30% margin, which is pretty darn good. But then look at the licensing business, QTL. It brings in only $5.6 billion, but the margin, 72%. So way less revenue, but the profit it spits out is just on a completely different level. That is the royalty engine at work. All right, let's shift gears to layer two, the growth platform. Now, this is the part of Qualcomm you probably do know about, the actual chips, the QCT business. But the big story here, the thing that's changing the game, isn't just phones anymore. It's all about where they're going next. And speaking of where they're going next, get a load of this. $45 billion. That is the size of their design win pipeline for the automotive industry alone. Now, let's be super clear about what that means. That's not 1 year of sales. That's a pipeline of future revenue that they have already locked in. It's deals that will pay off for years and years to come, which makes it so much more stable than just waiting to see how many phones sell next quarter. And this isn't just some pipe dream for the future. It's already happening. Look at the revenue breakdown from fiscal 2025. Yeah, handsets are still the biggest piece of the pie, no doubt. But automotive and IoT, the Internet of Things, they're already pulling in a combined $10 billion plus. These are real, massive businesses today. And the company's not stopping there. Management has put a target out there. They're aiming for a combined $22 billion from auto and IoT by 2029. Now think about that. If they can pull that off, Qualcomm is a totally different animal. It's no longer just about the next iPhone cycle. Okay, so let's recap. We've got this incredibly profitable royalty engine, and we've got this fast-growing, diversifying chip business. So what does that all mean? Well, that brings us to layer three, the valuation arbitrage. This is the really juicy part. This is where the market's myth about Qualcomm creates a fascinating situation for how the stock is actually priced. Just look at this. For fiscal 25, their official earnings per share, the GAAP number, was about $5. Okay? But if you look at their non-GAAP number, which strips out some weird one-time stuff to show you how the actual business is doing, it was over $12. That's more than double. If you're an investor and you only see that first number, you're getting a completely warped picture of how much money this company is actually making. So you're probably asking, what in the world causes a gap that big?
Well, it's one thing, a $5.7 billion tax charge that was non-cash. It's some complicated accounting stuff, but here's all you really need to know. It wasn't actual cash that went out the door. It's basically a phantom charge on the books that makes the stock's PE ratio look way, way higher than it really is.
So, if PE is misleading, what should we look at? A much cleaner metric is to compare its total value to the free cash flow it generates, the actual cash pouring in. And on that basis, it's trading at around 11 times. Now, for a business with these kinds of margins and this kind of growth, let's just say that is not what you'd call a crazy bubbly valuation. And that number, that 11 by multiple, it really tells you everything. It tells you that the market is still stuck on the myth. It's pricing Qualcomm like it's just a boring old phone company that's past its prime. It seems to be completely missing the reality of that high-powered royalty franchise we've been talking about. So all of this brings us to the core debate for any investor looking at this company. We've seen the three layers: the royalty engine, the growth platform, and this potential valuation disconnect. But of course, it's not all sunshine and roses. We have to be fair and talk about the risks. And there are definitely some big ones. You've got the whole Apple situation. What happens if Apple makes all its own modems? That's a huge question. The phone market itself goes up and down. Their licensing business is always fighting legal battles all over the world, particularly in China. And of course, there's always the chance that this big diversification push just doesn't work out as planned. So really, it all comes down to two completely different stories. The bear case is that at its heart, Qualcomm is still just a handset company, and that amazing royalty moat it has is starting to crack. The bull case, it's that Qualcomm is transforming into a diversified platform, and the market still hasn't woken up to just how valuable that royalty engine truly is. And that leads us to the final question, the one you have to decide for yourself. Is Qualcomm the company the market seems to think it is, a simple handset company, or is it something much more, a diversified platform with this incredible, underappreciated royalty engine? How you answer that is everything when it comes to figuring out this company's future.